actually this, I hate seeing this, but half of their total assets is goodwill. It's like a massive line item for goodwill. But even if you completely take that out and we're to ignore it completely, it's still a really healthy balance sheet. Okay, welcome back, everybody. This is episode number 17 now. Our most bearish thesis actually appears to be coming true. If you've seen SoundHound AI stock, it's down over 40% now since we published our negative view. So there's further to fall. Watch the previous episodes if you want to see our take on that. Of course, we got Trend Tracker Pete in the house. Pete, how you feeling about the markets and the economy right now?
Yeah, I mean, still top heavy. I think we're seeing on the S&P almost 40% of the value is in the top 20 companies. So I'd like to see that being spread out a little bit more. And I think on the TSX up here in Canada, you're about 20% is kind of, in the top 20 companies as well. A little bit different in terms of diversification, though. What we're seeing in Canada, it's a little bit more spread out with our financial institutions being 1 and 2. Banks can definitely make a lot more money in high interest environments. But, the States, I think we're definitely seeing a lot of things in terms of a bit of an AI bubble and the fact that they're not being as harmed by consumer spending. It's just the economy that won't stop. So they're still spending and people are finding ways to kind of invest in companies where consumer spending benefits, like the Googles and Metas of the world.
Well, there you go. 45 seconds in, and Pete's already mentioned AI. What else is new? We got Mr. Fundamentals here, of course, as well. World's most likable analyst. You actually just wrapped up a major project, our first quarterly report, and it's a beast. You guys are going to really love this. Declan, after writing that whole report, did that make you feel more bullish or bearish on the markets?
Yeah, great question, Kev. Frankly, I am probably more bearish than ever. Really since the beginning of my investment career about 4 years ago, I was kind of preaching that, okay, maybe we'd be in a bubble. And that was just as I started learning things. And then, of course, we had some form of correction. But now we've reached a point where we kind of went unscathed in terms of a recession when everyone thought the recession was happening. And now we just have this culmination of investor mania that is driving up stocks that deserve no reason whatsoever to reaching the valuations they have. So, whether that's across the Magnificent Seven, and we're certainly seeing some pullback in companies like Tesla, but then across smaller businesses and even like the AI company we're going to talk about today, I think really people in the market right now are seeing that AI is driving a lot of this growth. And whether that is fundamentally correct or not has yet to be proven. But I think regardless, there's a lot of FOMO in the market right now. People want to get on board and they're willing to do whatever it takes without really foreseeing the consequences. So I'm more bearish, ultimately, hopefully the smaller markets that really we cover here have a better opportunity in the future because they didn't face such a high kind of run up or shoot up in the recent period. So certainly still skeptical of the market overall.
Bit of a weird time for market mania, hey? The market is one thing and the consumer seems to be another. The average consumer is certainly not all right, not healthy. You just saw unemployment numbers come in for the US. They came in higher than expected. So everything points to a consumer that's still struggling, yet a stock market that's ripping on the back of rate cuts, hopefully, AI causing a boom in corporate profits, et cetera, et cetera, et cetera. It's just funny seeing how the stock market and reality can be dislocated. But I'm glad that you said something about smaller companies because, we just recently put something out showing that you look at, large cap index, medium cap index, and small cap index. Larges have ripped, especially in the growth side of things. Mediums have, you could still say they've been really healthy. They've ripped. Small caps done okay, but less than half the return of the large stuff. So just fundamentally, risk is a lot lower there. That's the area we're excited about. Let's use that as a segue into our first couple topics. Cool things on the agenda today. We're talking about a hydrogen fuel cell company. We got another SPAC deal that's in the AI space and a payment processor that is seeing revenue go boom. So why don't we kick right into it? First piece of news is related to the SPAC. I was mentioning CXApp. It's on the NASDAQ, CXAI. They formed a strategic partnership with Google, or so they say. We'll dig into that to enhance the workplace experiences. Couple key points. So CXApps, they've got AI native platform. It's now integrated with Google technologies. They aim to revolutionize workplace experiences through personalized interfaces and generative AI applications. Okay, it's a really cool app if you looked at it. Number two, Google Cloud's going to empower their platform with advanced services that include security, performance enhancements, facilitating transition for clients and potential revenue growth. Final key point, the inclusion on Google Marketplace and a go-to-market partnership. It's going to broaden CXApp's client base and standardize solutions for a larger audience. So, okay, let's talk about Google Cloud here. Declan, how do you think their partnership with Google Cloud is going to impact their competitive position in the market?
Mm-hmm. Yeah, so when looking into this business and trying to make sense of it all, it is difficult for me to understand some of it. So I actually kind of wanted to throw it back to you guys quickly, and then I'll kind of share my thoughts on the partnership. But I'm just going to list a set of features that CXApp outlines that its workplace super app has. And then I kind of want you guys to tell me if back in your days when you were in office all the time, what you think of those features and if you would have found them beneficial. So they talk about the ability to book desks, book rooms. They have an office mapping and indoor navigator, which is essentially just a Google Maps or GPS for inside of buildings. You can find your colleagues if they're on the other side of the building. They also have workplace analytics that integrates both native data from the Workplace Super App, but as well as third-party data from their partners or the other software that they've integrated into the system. Then they have internal communications, which is just essentially like a news feed when you look at it, and then as well as notifications, proximities, and ability to make reservations with the various amenities on these platforms. So I was curious if any of those stood out to you guys, and then I can kind of chime back in about what Google offers.
Well, Declan, thank you for saying back in your guys' day. Appreciate the context there. It's been a minute since I've been in an office.
I don't mean that. I come to the office every day. This isn't my house, guys. I'm at the office right now. This is a room in my office that has other rooms that we have tools that use to book. So still very relevant to me. But
Pete's got a big boy office. This is true.
Come on. I'm here every day.
So let me throw it back to you then. Do you think that these features within it would be useful, or does that say the software that you already have would this super app kind of relieve some of the pain points that you may be facing in the office?
I don't know why this is a super app. This stuff has been around for a very long time. I think this entire press release is what I would call a puff piece. Them building this on Google Cloud really doesn't make that much of a difference. They could have built it on AWS. They could have built it on Microsoft Azure, and they're in the Google Marketplace with 5,000 other businesses. I do not have any understanding why this lifted the stock, and I've read the press release multiple times and can't find anything new other than a term called experiential analytics that makes me just feel like they're tracking what their employees or hybrid office workers do.
Oh, you know they are.
The only thing this does is support a 17-week running joke on every pod that if you put AI in your name, your stock will go up. And this is just proving that. I don't know, guys. Can you tell me something I'm missing here while this $5 million a year company blew up? It's an app that books rooms.
Yeah, I mean, maybe did we mention it's super? It's a super app. You know what? It's funny. I think, I'm in my home right now. Do I need an app that's going to help me book a room or find colleagues? No, probably not. Pete's office is certainly bigger than mine, but I think you can probably poke your head out of your office and find everyone you need. Obviously, it's a solution for mini campus style employment. Like you have to have a pretty big campus to need an app like this. In their defense, I mean, it sounds like a cool app. And if I was on a Google campus and I wanted to book rooms, locate friends, learn about amenities, sure. I mean, I could see myself using it. Is that big of a technical innovation? It doesn't feel like it to me. I don't know.
It's been around, guys. This is what I'm trying to say is right now we can do that. We have that integration with Gmail, with our booking software and the ability to reserve this stuff. So when I was looking up this company, and obviously this press release read like an investment or a real partnership or something along those lines. And I really couldn't find it. And when I was looking at their features, maybe they're a little bit better than some of their competitors, but these have been around for a while. The ability to reserve a boardroom has been very easy to do. And even in, we're not a billion-dollar business, but the ability to put an iPad in front, you can do a QuickBook, you can do it in, in the future, and it integrates with your Google Calendar. They even have ones that create invites. So I'm really missing what the hype is here, and what someone might need to walk me through what the generative portion of this is. Is it like they create better instruction manuals, how to get around your office? Or I get it maybe for hybrid, you have contractors coming in, maybe co-working spaces, but I imagine when WeWork started co-working spaces, they had something similar to this to reserve some of those areas too. So,
right.
Well, okay, maybe I'll jump in one more time. Then Declan, I know you're excited to get into it. What I'd say is like, I see a tale of multiple companies where if you're Apple, you're probably just going to build your own campus app.
That's
yourself.
right.
If you are you and me, you don't need an app. So there's this like really thin area where maybe you don't want to put the resources into developing your own app, but maybe you do actually see the benefit of having kind of, it seems like it's the culmination of many features into an app. So maybe if all these things exist individually, maybe their innovation is that they put it in a unified super app. And that's supposedly, I could see some value in there. I don't think it's going to be that defensible. I think this Google partnership, just like you mentioned, it really feels like a fluff piece. I was looking for some, like you said, an investment or some kind of sign of Google putting their money into this in one way or another. And it just seems like they're just using Google's services. So I think that was a pretty misleading app there. Mm-hmm. I don't know, Declan, what are you thinking?
Yeah, so I think you guys nailed it on the head. First, to your point, Kev, when I was looking at this thing and the way they outlined the business, especially a lot of these features, it seems like it's reserved for these businesses that are quite big. They have a campus, like you said, or some size of, headquarters or various, buildings that they use that are large enough that you require a map to know where the heck you're going. And so that's the first part, is probably these businesses that face maybe these inconveniences are developing their own system in-house that is probably much more useful than something outside that they now have to find a way to integrate. And as well, from a business with significantly less capital than what they probably have themselves. The second part is that I just don't think that they've really defined what their MVP is. Here, you have a business that offers multiple features. And when you look at them and, they offer a video kind of displaying it, it just doesn't look like any of the features are very well thought out. And then on top of that, you have to compete, and this is to your point, Pete, against individual apps that are significantly better and really good at what they do. So whether that's Slack for messaging, that also, of course, includes Microsoft Teams. And, Teams may be kind of the all-in-one application relative to most of these businesses here. But, we have project coordination apps like ClickUp. There's plenty of data analytics platforms, whether it's Databricks or Accenture, all these different Google as well and everything. And then meeting apps like Zoom. So they are trying to build this application where none of their features are the standalone product that people are going to find value in. And so when you look at it now, and as you guys discussed too, when it comes to Google, well, where is the advantage or any advantage that they have? And I don't see a competitive advantage for this business. Now, by integrating Google's technology into its system, it will enhance the business, and they probably are going to be able to, create better exposure, have better performance, even be a more stable and secure platform than they otherwise would. But it's not like they're separating themselves from the competition. And like you said, Pete, this really does sound like a fluff piece. It's not like Google went and handpicked CXApp and said, hey, we want you to be our workplace super app. This is more like CXApp being a customer of Google and Google offering the services they would to any one of their customers. Why? Because they ultimately want their customers to be successful. They make more money when their customers have more downloads, when people are using the applications that exist on their marketplace. And so, yes, they will do everything that CXApp mentions in this press release in order to bring this product to market, leverage its various AI and generative AI model technologies, such as Vertex AI that it lists, and then ultimately using its cloud infrastructure to be able to store that data and then easily translate that into analytics for their customers. And then ultimately that will lead to some product success, but it's not a point of differentiation.
Yeah, again, reading this press release, other than a 17-week running joke between me and Kev about rebranding yourself as .ai or AI, I don't see what they're doing that I couldn't do this press release tomorrow if I owned any app and just saying I'm migrating to Google Cloud and using their modernization services. Yeah, again, you could do that with anyone, and Google's all for you giving them press of you moving to their cloud server, leveraging an LLM. Not that hard. I can go do an API right now. So, I mean, what did they do? 5 mil in revenue, and they're worth 7 mil. Declan, I think around there.
Exactly.
They're getting 10 times revenue right now as a cap. I don't know who their customers are. They have very few listed on their website, so I don't know who's implementing them or necessarily what a pricing model looks like. We'll have to see, because I mean, the only blue sky here, and I'm going to say it, is data. So we'll see what they can do with that. But if they don't have enough users, I don't necessarily know how they could reform. Things like this at those bigger companies are super difficult to implement as well. Change management, getting a lot of employees to learn a new system, it is, it's not easy. The only thing I could say devil's advocate on is there could be a potential exit one day to an HRIS who's not doing this and that doesn't want to build it themselves. So if you're that acronym is a human resource info system, which are usually payment processors, you'll do like employee engagement, you can do one-on-ones, you can do management. Adding something like this within that ecosystem for a company that's already successful could be the only way. But the only time I would kind of see that is probably while this is on the way out. So I don't think they would be paying the price it's worth today.
Purely from a financial standpoint, dollars and cents, this thing isn't crazily priced. I think it was. If you guys didn't know, this was a SPAC deal, actually. It used to be called KINS, K-I-N-S. So it was a SPAC deal. They found this. They actually purchased this app out of an existing public company, a public company in Pixon. We'll actually talk about them later. There's another company involved in Pixon, Damon Motors, electric motorbike company that I want to discuss. But anyways, for now, that's why I recognize the name. So they bought it from them. They needed a SPAC deal. It looks like they way overpaid for it. They paid over $70 million, all stock. But from what I hear, you can get roughly an eight times your annual recurring revenue is supposedly fairly standard in the industry. So where they're trading is not crazy, because I read in this financial statements that about 80% of the revenue is ARR. So from a valuations perspective, it's not crazy. It was when it was first freshly out of a SPAC, but the price has come a lot down since then. I'll also give them credit. Like, their gross margins are actually pretty good, 79%, actually very good, 79%, up from 71% previously. So I think that's good. Revenue though, this quarter compared to the same one last year, it's flat, hasn't really grown. So it's a growth stock minus the growth. That's going to immediately bring down what kind of multiple you can get. It already makes that 10 times sales start looking really expensive. Don't be fooled as well by the latest financial statements. You saw a profit, but that wasn't like a real operational profit. That was just basically changing the valuation of, it was a $5 million gain on derivatives. Long story short, it's to do with their listed warrants. The stock crashed, and what that does is you actually report a gain on the other side of that. So it's not like a real profitable gain from operations. So just ignore that completely. It's just, in my opinion, I don't think the app seems incredible, but I think it's good enough that I could see people using it. I would just need to see growth. If there's no revenue growth, it's not a growth stock, and you're not trading at 10 times sales. So until seeing that, nothing gets me excited, because especially you dig into the balance sheet, it's really unhealthy. It is not a healthy balance sheet at all. It's bad.
But you did bring up some good points. I would say it is good to see that they got their gross margin in line already. I mean, realistically, it should not cost them more to get new customers. That's why people like SaaS, but there's other SaaS plays out there. What is difficult in SaaS is cost per acquisition. I think they might need to work that out. They're not getting a lot of organic search. There's not a lot of people hitting this website. I don't think they have much of an inbound strat. They're probably paying salespeople to go out there, and they really need to form probably partnerships and as many integrations as they can. But it's a tough, this is a tough nut to crack, this market. So we'll see what the AI actually does. I'm interested. I'll give you guys a free demo with my team.
Yeah.
If you're listening.
Love it. Yeah, I was just going to say one last point is I just don't understand why a management team would issue this type of press release and where it essentially misleads shareholders.
Yes, you can.
Because
you know exactly why. You know exactly why.
Well, I understand why they did it, but I definitely understand why they did it. But I mean, from a long-term standpoint, you ultimately have to realize that you're setting a really high bar for yourself now. You said you have a partnership with Google. You're saying that you have all of these AI capabilities. And now if I'm somebody coming in, or say I'm a naive investor, obviously my expectations are that you are partnered with Google and that you have this AI technology. So when I don't see this, sure, that's congratulations. Your stock rocketed for 1 week. But like a lot of the businesses that we've dissected here that don't have real strong fundamentals and not a clear path to profitability, to long-term sustainability, you will come crashing down, and you have only yourself to thank for that performance. Because if you don't be honest and uphold that level of integrity with your shareholders, you don't deserve to be a successful business over the long run, wherever it goes.
Yeah, and this likely won't be. But I didn't know it was a SPAC, so thanks for pointing that out, Kev. Great reason to put out this type of news when you have a SPAC is a bunch of people can sell the stock. So
Exactly.
Probably good to try and keep the stock up while people have a selling window and they're probably trying to bail, because that's the only reason you'd really put something like this out that isn't real news. So. All right.
We're long past the 6-month mark from when this deal was closed. So virtually, there's a lot of stock that can be sold. And I'm sure we're going to see that happening. Not to mention, when they acquired this company, they actually gave InPixon shareholders stock. So I've had a stock dividend before. And in my experience, people often sell. It's not a company that they chose to invest in. Well, sorry, that's not entirely true. That's not entirely true. They didn't necessarily invest in this company on a pure play basis. So we don't know if they liked InPixon, this subsidiary specifically. Did they like the whole business? So the fact that they're getting shares of this newly spun out company, those shareholders are now going to decide, do we believe in the long-term fundamentals of the business, or is this a nice dividend that I received from a company that I like the parent company of, and I'm looking to sell it? Typically, it's the latter. I often see these stocks getting dumped. So something to keep in mind, when you're looking at this thing from an investment perspective. Okay, well, I think that's about all the juice we need to squeeze from that. Let's move on to fuel cells. Way more interesting. Homegrown company. I'm here in Vancouver. Ballard Power Systems. They're now on the NASDAQ. I've known about these guys for a long time. They secured the largest order in their company history for hydrogen fuel cells. It might actually be one of the largest orders for hydrogen fuel cells ever. I'm fairly certain, and I'll look that up. Few bullet points if you're not familiar with the news. They signed a long-term supply agreement with Solaris Bus Coach, European bus company, for the supply of 1,000 hydrogen fuel cells. As I mentioned, largest order in Ballard's history. So point number 2, these engines are going to power these Solaris buses all across Europe, with addresses both the 12-meter and 18-meter bus markets. Deliverables are scheduled from 2024 to 2027. Final point, supported by policies to decarbonize public transport fleets. The transition to zero-emission buses, it's accelerating. Hydrogen fuel cells are offering a zero-emission solution, quick refueling, long range. There is lots to like. Pete, why don't we start with you? In Europe, there's obviously policy tailwinds that support decarbonization. What future opportunities do you see for Ballard in the European market and beyond?
I think in the European market, all things are trending to this decarbonization and, overall things moving towards EV. And I think maybe there it could look good, but there's so much geopolitical influence at play. And a lot of that worldwide is going to depend what happens in the United States in November of this year. And if someone wins, his decision the last time he won was to immediately pull out of any climate agreement, which will then kind of have a bit of a ripple effect throughout the world. I mean, hate to politicize this, but there are typically, this is more of a left wing kind of political agenda that looks into decarbonization, carbon credits, all of these other things. However, we're starting to see some things flip a little bit more right, even in Europe, with countries like Italy having elected more of a right wing person who tend to care about this stuff a little bit less, or on a bigger side, just fire up the coal power plant whenever they can. So I think it's an interesting year for them. I think it's a great deal. I think, they're doing real revenue. This type of stuff requires a ton of R&D. So I don't really want to hold them too accountable for what they're seeing on the bottom line, because the long-term outlook would likely be good, especially when you're looking at shipping and logistics, and if that can save businesses money, in addition to be potentially better for the environment.
Yeah, it's interesting you say that, Pete. And I think that is something that investors do need to keep in mind, is there's obviously different approaches and ultimately agendas tied to where these businesses, or that may affect or impact the fundamentals of the business itself. What I'm quite interested in, and as you said as well, is they've spent considerable time in this field. I think they're like a 40-year business. Like, they've been around for a long time and really honing in on this technology a long time. We'll dive into it a bit more later, but when I was looking at their customer base, another thing to keep in mind, and when it comes to even Solaris here, is that they've been working alongside them for about 10 years now. And they have like this 3-pronged strategy where it goes from development to demonstration and then ultimately deployment. And they've reached the stage now, not just with Solaris, but multiple customers, where they're now in that deployment stage. And that's obviously why they've reaped in the benefits of this, $1,000 fuel cell engine market or opportunity or contract or whatever. And so what I see here is they've kind of overcome a lot of the hurdles that would prevent possibly a smaller business that really needs to bank on local politicians and some of those, domestic actors to really support that push forward. I think they've kind of overcome that to some extent. They're a much more mature business, and they have the backing of these really strong and large companies such as Solaris, and as well as Siemens on the freight front or freight side of things. So that's where it's interesting that I think they may be able to overcome some of these maybe political hurdles that would impact smaller businesses.
Interesting you say they're a 40-year history. That's even longer than I would have thought. I know their first fuel cell bus came out in 1993 here in Vancouver. So that's that's coming up on 30 years there. So I guess they were producing these before that. So certainly they're one of the first movers in the space, if not the main first mover. There's definitely competition, but they've built a name for themselves. You look at their balance sheet; it's an incredibly healthy balance sheet. Like this, long term, I can't speak to their solvency, but short term liquidity, like they're not going anywhere soon. They've got about $1 billion on the balance sheet. Maybe did I get that right?
753 million cash on hand.
Okay, 753 million cash on hand. They're doing 100 in revenue. It was 80 the year before, so they're growing quite well. Mm-hmm. The thing is, though, it's a hugely negative margin business. Like, it's cost them more to produce these things than they can sell them for. So they have a massive cost problem. Something you guys might find interesting, actually, they're building what they quote as a fuel cell gigafactory in Texas, of course. And they've received about $100 million of government support to do it. So pretty amazing project. And I mean, if there's ever a chance for them to fix their gross margin problem, this would be it. Mm-hmm. It's the same approach that Elon took with manufacturing batteries. Scale is the only way to bring the cost down. So I'd say I'm optimistic on them being able to find a way to get COGS down where they're actually going to be gross profit, positive. It's a big question, though. Obviously, we never really know for sure. We can only hope that it goes that way. But at least they're growing revenue, which is good. And the valuation, though expensive, it doesn't seem insane from a sales perspective. I don't know if you guys disagree. Pete, you shrug. Do you disagree?
No, I tend to agree. I'm sure whoever bought in mid 2021 or early 2021 feels a little bit different of whatever that crazy valuation they got then. But where it's priced today, depending, like I say, and like they're not going to go anywhere, right? They'll be around for a bit. Government grants definitely could be in their favor in a lot of different ways. I'm interested in this one. I didn't know about it. You guys put it on my radar. It really shouldn't be going down for any reason.
They're losing a lot of money. Their net loss from continued operations. There's a few different net loss numbers you can look at, but net loss from continued ops is minus 144 million. So people are obviously nervous of that. Their gross margin problem has actually gotten worse over the year. Their COGS, are now 21% more than their revenue. Last year was 16. So I think people maybe are seeing the gross margin going the wrong way. Operating loss is still heavy. Maybe that's scaring people.
It's got to be a challenge though for them to forecast some of these inputs at such a small level, right? Mm-hmm. So a big order is 1,000 units. When did they, like, the cost of inputs everywhere have gone up. So for them not manufacturing at massive scale are going to see those swings, I think, quarter over quarter until they really stabilize and really solidify kind of a demand in the market.
Yeah. Mm-hmm. Well, I wanted to say that their financial position has frankly been, mediocre to some extent in terms of when you look at the income statement. Like you said, Kev, they've made about $100 million in revenue, and it stayed generally flat aside from last year where it did dip to 80 million there. But from a net loss standpoint, it is growing a bit. And I think it went from $50 million net loss to $170 million over the trailing 12 months. And so I think that's where a lot of the negative sentiment is mostly tied to. But the thing is here that I think we are exploring this business at the perfect time. There has kind of been a convergence between technological advancements, environmental threats, and then as well as deglobalization and incentives, whether it's the Inflation Reduction Act, and ultimately just pushing for more independence when it comes to development, resources, and supply chain, all the like, you name it. So I think there has been a convergence across these multiple factors that is going to benefit Ballard, who has been, again, working on this for nearly 4 decades now, and is positioned not only with one of the top bus manufacturers in Europe, but as well as one of the top freight manufacturers. I also saw that they were partnered with CP Rail and other various, markets within the maritime sector, emerging markets, even some like heavy machinery. And so when you look at it and what they actually outline is that they have enough conviction to believe that they'll have above a 10% market share in each of these markets. I think for their top 2 main ones right now, buses, they think they'll get about a 15% market share. And for freight, they'll get about a 40% market share. And the culmination of all these markets, when you look at what they address as their total addressable market within the fuel cell market, is that by 2030, they'll be able to generate about $1.96 billion in annual revenue based on, again, where they capture the market, not just the total addressable market, but that percentage that, is relatively conservative enough that they should be able to meet those expectations, of course, based on all the work they've done. And lastly, as I kind of said before, is they're not in the development stage anymore. They've kind of figured out most of those technological hurdles that may have limited the business from being able to deploy these from a marketable standpoint. And now they're proving this. So I really do believe actually that Solaris's order of 1,000 units is just the beginning for them. As companies start to see the benefits, and of course with the carbon credit initiatives that are going on now as well, there's a lot of incentive for companies that emit a lot of greenhouse gases today to turn things around. And ultimately, if these fuel cells are efficient and you can use them for a long time, they're not too difficult to refuel, and they probably cost less than natural gas, then ultimately that's a beneficial product regardless of where you stand from that political side of things, and just assessing climate change overall.
The main issue with hydrogen energy is, where do you get it from, right? Because the majority of the world's hydrogen actually comes from fossil fuels through methane reformation. Give it a Google if you're not sure what that is. But point is, it requires fossil fuels to create hydrogen in a cost-effective way, so that in many ways eliminates the benefit of having hydrogen. The other common way to make it is, of course, electrolysis. If you're not familiar with that, you're taking H2O, water, and you're splitting it into hydrogen and oxygen. It takes an enormous amount of electricity. It is not an efficient process at all. It's getting better, and it'll continue to get better. That's the only known clean way. There actually is a third way that's not often referenced. And the only reason I know this is a really good friend of mine runs a hydrogen energy company. You can actually collect waste hydrogen. For the sake of his trade secrets, I won't get too into the details, but you can. There's a lot of hydrogen vented into the atmosphere, and there are areas you can catch it. So there are other elements, but from like a really scalable greenfield way of producing hydrogen, it's hard to get a green and cost-effective source. I think that's going to be the biggest hurdle. Second biggest hurdle being refueling infrastructure. Think of all the concern people had with electric vehicles, not knowing if they're having range anxiety. Am I going to be able to charge this thing? Now you see gas stations everywhere have superchargers. The same thing's going to happen for hydrogen. It is to some degree. It's just not very far along yet. So you've got these two gigantic hurdles you have to overcome. But if you overcome this, I mean, hydrogen is the most abundant element on Earth. And in at least in action, when it's being used in a truck or a train or something, there's no emissions at the source. So it has a lot of promise. It's just, how do you make it in the first place? That's going to be the key thing. And Ballard's not even going after that problem. So to some degree, they're really reliant on somebody else solving a problem that they need to get out of the way before they can really, 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 really scale.
You were incredibly well versed on hydrogen, sir. Do you have a deal coming up? Like, what's going on?
I've been trying to work on one for like 6 years.
Okay, that was impressive. But I do actually have a couple questions on that. One more of a comment. I mean, this is just something that goes on in the EV space, I think, in general, that when you follow the supply chain down, the benefits to carbon or how green something is always kind of interesting. Because let's say if you're leveraging lithium batteries that need lithium, copper, cobalt, all these things at the end of the day that need to be mined out of the ground by massive machines and shipped somewhere, right? So there's definitely always seems to be a bit of an issue. And, in terms of carbon, I don't know who gets dinged with that, which company themselves. But I was actually a little bit interested on the methane reformation that you called it. I know you're not a geologist or anything like that, but I would actually like to just be curious what that is in more detail, if you can explain. But
I can give you a little more detail, but basically methane gas can react with steam. And I think there's a catalyst required. I forget what metals it is, but I think there's a catalyst required to start that reaction happening with the produced asset being hydrogen. But it requires, and honestly, the Google machine is going to do a way better job explaining that than I will. I'm not a scientist. I just know, I can just read the words that I'm just regurgitating what I've read. But it requires fossil fuels. So that's kind of the issue. And that's where, like, I believe it's 95% of the world's hydrogen comes from right now. So it's currently not nearly as green of an industry as it will be in the future.
Okay.
I'd be curious, Declan, you actually pointed out a few things that I missed. I only looked at the latest annual statement. So I saw this year and last year. I saw the revenue go from 80 to 100. I didn't realize that 80 was actually a dip. I didn't realize it had actually dipped before it jumped. So that's not a great sign. Kind of takes away the bonus points I gave them for growth over the last year, unfortunately.
I think you raised some really good points, Kevin. This is that balanced perspective that I think really helps people understand these green energy markets, that you may look at it at first glance and see all the positives that come from it, but there's things hidden behind the challenges. And like you talked about, scale, even building the right infrastructure to bring these things to market and be able to use on a widespread basis is a bit challenging. And so I'm certainly curious, because it's a company that, again, has spent considerable time at least developing their own proprietary technology and how they implement that. perhaps this will be the start of something that is, a real trendsetter in the market itself. But again, you have to stay grounded and look at it from that economic standpoint and where it can be developed.
Mhm, mhm. There's a lot of reasons to want hydrogen to succeed, other than it being obviously very clean. It's a very functional fuel. Pound for pound, it has a higher energy density than something like natural gas, for example. Um, it has excellent range. So the range anxiety, like it'll outperform a similarly built electric equivalent. So it has good range, it has good power. It's got a lot of negatives too. It's a very gaseous, you have to really super cool it if you want it in a liquid, or if you're going to keep it in a gas, the tanks that you have to hold it is just giant. Elon Musk, he's actually fairly negative on hydrogen for those reasons. Saying, but also he runs a battery and electric car company. So what do you expect him to say?
Yeah.
But I mean, it's still good points for sure.
Yeah.
Okay, boys, let's move on to final topic, Lightspeed POS. Here's another Canadian company, actually. Lightspeed Commerce. I call it Lightspeed POS. I don't know if I'm mixing that up, but Lightspeed Commerce, they implemented cost reductions, a share repurchase program, and they're really focusing on profitable growth. You'll understand why momentarily. It is time for them to do that. A little bit more about the cost reduction measures. They're reducing their operating expenditures by approximately 10%, which is, I believe, 10% of their human costs, if I'm not mistaken. They've also been authorized for a share repurchase program of up to $140 million. How they're going to pay for that, that's a whole other story. We'll get into that. They are reaffirming their revenue and adjusted EBITDA outlook for fiscal 2024. They're confident in their financial performance, their strategic direction, and the announcement yesterday about focusing on profitability, I think, is something the market is really dying to see. So, Declan, what benefits do you see coming out of a share repurchase program?
Yeah. So the world seems quite divided on share buybacks in general. On one side, you have a lot of politicians that push back on them and say that capital could be used more effectively. And even when you look at Lightspeed here today, this is probably going to add more fuel to the fire on that standpoint, because they cut 10% of their workers. Those are jobs lost. And they're deciding to just put that capital back into exit or deleting shares essentially from the market. Now, that being said, I generally do believe that buybacks are an effective use of capital as long as the business buys them when the market has valued the business below what it is intrinsically worth. And so, ultimately, just to understand what a repurchase program is doing is when a company buys these shares from the open market, they essentially are retiring those shares. And this makes it so that the total shares outstanding is less than what it previously was. So what happens in that instance usually is the share price typically increases. Again, if it stays at the same market cap, you're ultimately gaining more ownership. And so the share price should increase. Second to that is that your earnings per share that you have in the business should also increase. So as the company continues to grow and you reduce the number of shares, you have a larger ownership stake in that company, and you now benefit from that higher degree of concentration than what was previously there. It also allows people who are potentially trying to sell their shares and may not be as long-term shareholders to actually find an exit strategy that is attractive to them. So now when you look at Lightspeed itself and with this share repurchase program, I think it's a good decision overall. When you look at the business, it's down 89% from its all-time high. It had about a price to sales of 2.46, which is quite reasonable, and a price to book value of 0.87. And so it seems that the management team understands that the business is probably undervalued. And so they have confidence that this is an effective use of capital. They can generate higher returns by deploying it in this method and ultimately seeing how that benefits over the long run. Now, on the flip side, my question is because the business is not profitable and hasn't reached profitability yet, why is this the best choice of how to allocate that capital? Certainly they've grown at a really impressive rate. I think their revenue has grown like 75% annually since 2019. And they're doing a lot of things right. And when you look at those financial metrics, it is really impressive. They're doing like 87 billion in total gross transactional volume. They grew their subscription and transaction-based revenue 36% year over year. So there's a lot of things pointing towards, well, this business is growing fast. But if you could use that money that cash that you've built up over the years by ultimately diluting shareholders in the past, why not use that to continue that growth and really try and blitzscale and build up your business? Because you are competing in a market that includes companies like Block, Nuvei, as we've often talked about, Stripe, Shopify, and PayPal, and many others and a lot of these businesses are profitable, and you're the non-profitable business. So how are you going to get to a standpoint where you can maintain that competitive advantage? And then just the last point on that problem of buying back shares rather than holding on to the cash or deploying it in another way is we're not necessarily out of the clear when it comes to economic calamity. And so if things take a turn for the worst, and now you've put this capital into buying back shares when maybe you should have held on to that cash and used it more conservatively, you're ultimately left in a situation where you have less cash, you're losing money, and not just a little money, you're losing about 200 million per year. You lost $1 billion last year. So what are you going to do if situation turns for the worst and now you're more cash strapped than ever and you may not be able to raise the same capital? So yeah, that's my thoughts on it overall and where the business is at with the share repurchase program. There's obviously benefits to it, but there's also some cons as well.
Interesting comments for sure. I can't say I agree with all of them. I don't know where maybe I should start on that. So let's talk about the company as a whole. I don't think they're growing as fast as you're saying. I think they actually got called out in 2021, the way they were actually reporting their revenue and allocating too much of basically what I'll call a complete flow through, which is what sometimes people do in the payment space, or maybe in this case, the POS and payment space. And their stock absolutely crashed. I mean, a lot of people that happened to a lot of people in 2021. But this is not a new company, and I think that is actually what's working against them the most. I think this is a company that started in 2005, and when you were thinking of the technology in 2005, you weren't really on cloud native or cloud-based systems yet. Declan, this is back in me and Kev's day. But the idea of an iPad really hadn't come out yet. Touchscreen hadn't come out yet. So we're using these POS stations that really are not feeding, internet to shared drive, feeding information or data to shared drives, retail sales. Maybe you're still printing out reads, all those things. Since then, the barriers to entry to creating a POS system has went down big time. It is so easy to kind of do this. And they had to keep kind of catching up to what other people were building easier, because they had to continue to kind of modernize their platform, which would be these huge releases, because they had all these existing customers, right, that were on legacy platforms that they would have to update. So that is very much a challenge compared to someone like a Shopify, who comes in and says, yes, we are an e-commerce POS. And then they decide to go into the payment space. And then they say, if you started, let's say, as an e-commerce business and you open up a brick and mortar location, well, we'll just give you an iPad, right, for your retail store. I think this is really probably what's been challenging them. And it might not be through any fault of their own, just the nature of the business. The technology got easier and you could create basic POSs with people from Upwork, to be honest. Like if you're pretty good with wireframes and you can use a lot of open source, okay. Like, I mean, not to the level that this is, not to bring them down, but fundamentally it is incredibly easier to do this. So other people's products just got better faster. And when I think of acquisition, you got to kind of think of where the customer's at when they're making decisions of these POSs. And that is honestly why we brought up Nuvei. Was I loved how many integrations they were doing, that they were working with these POS companies. These guys got to the payments game late. It really wasn't really part of some of their thought process. And it's definitely an opportunity that they're saying from their launch date now that they're processing $6.6 billion in payments. That's awesome. You make fractions on that, by the way. But it's a really great business and it is recurring revenue with essentially very little to no variable costs. But they kind of missed out on that because there's so many of the other platforms that you mentioned, like a Stripe or even Shopify does their own payments. So these people really came out and started dominating, or Clover, and they integrate with the POS already. They've already opened up those integrations. So let's say you're a restaurant and you're punching something in for a payment, it's talking to the POS right away and closing out a table. And then the POSs themselves might integrate with your inventory, all those interesting things. It just would have been so tough for them the time they started versus new entrants.
That's an interesting point. I mean, I hadn't thought of that. And I think you're going to see that in a lot of spaces, especially with the emergence of these AI agents that can essentially clone websites, apps, things like that, use your color pattern and your copywriting, and it can actually make you copycat apps pretty quickly. So you'll see that. You see Chamath Palihapitiya, he's launching this new company. I think it's called 80/20, where it's deliver 80% of the functionality of a SaaS app at 20% of the price. And it's exactly what you're saying, Pete, leveraging open source, outsourcing talent to overseas, finding every way to make it cheap. And it's a debate that happens on the All In podcast about, is that the future? And they're at a bit of a stalemate because there are still a lot of vendors who, even if that's an option, simply don't want to even go there or think about it. I would imagine if you're a small retailer, you're probably one of them. So some things I like about the stock, I mean, when it comes to transaction volumes, just like you said, Pete, you make a fraction. I usually don't even look at that number because I know it's usually more fluff and marketing than anything.
Yeah.
Just looking at the revenue though, quarterly revenue, $240 million, up 27%. I mean, that right there is a pretty big growth clip. Margins are good. I mean, for software, they're not great. They're 42% down from 47. Software, you would rather see 70, 80%, if not higher. So they're gross margin challenged. I'd say that's one thing that's concerning. For me, I would say the big thing that I'm watching more than anything is the loss. It's not a new company. It is a growth stock, but they've come a long enough way that it's time for profitability, and they have all the pieces to start moving towards there. I think the latest announcement doesn't get me excited about that. I think it seems like a very, very marginal difference that a head like 280 employees is going to make in comparison to large expenses. I think they're going to have to do a lot more. But with the losses as reduced down to 40 million, it's not a huge loss. It is sizable, but it's not overwhelming. Like, I can see a path to eliminating that loss. It's just a matter of how much do you believe the CEO? How much do you believe in their commitment to profitability? Are they going to get shiny object syndrome and be on to the next growth initiative after this? That's the kind of thing I need to see. So I'd probably give it a quarter and really see, are they making any progress whatsoever before really reassessing?
And it's interesting. It doesn't feel like they've kind of maybe gone back to basics, where they're saying, in their own investor decks and presentations, that they're actually trying to grow, average revenue per user. So maybe it's not shiny object syndrome, but they're really focusing on retail and hospitality. And it is tough to squeeze more money out of some of your hospitality clients. It's a business that has razor sharp margins as it is. So I don't know what they're going to show a hospitality client. Personally, in my business, we've had to integrate with a lot of POSs. We have done a lot of work in the hospitality. I never came across them. Not one of our clients had ever used them.
Really?
In the past, actually, we worked with Touch Bistro as a client in the past, and they were specialized just for hospitality and really understood that user. And they were, one of those first kind of tablet-based ones, because these guys used to make a lot of money off of hardware too. When before you had these like tablet POSs that you could bring around, there was a great margin that they would sell you basically, maybe a reskin Dell or something like that, and make a healthy margin on it. And you got to keep these $5,000 workstations that cost them $1,000, and then they're making monthly recurring revenue off you. That opportunity is kind of gone.
Yeah. So two things. First, is kind of a pro for this business and just the economics of this POS market in general is I think there is a level of stickiness for customers. Once you've started to integrate one of these systems into your business and you use it for tracking those transactions, you're probably going to stick with the same supplier or infrastructure and
Mhm.
software unless you're dissatisfied and they fail to deliver on the value that you're seeking. So they outline in their investor deck that 96% of revenue is recurring or reoccurring subscription and transaction based revenue. So this is obviously a promising side of things in terms of those customers that they have brought on. They are satisfied. They're willing to continue paying for their subscription. They're willing to continue to use these systems that they offer. On the flip side of that is this, goes back to our conversation about Nuvei. And really what you've kind of outlined here as well is that this market for payments, it's massive. But
Mhm.
there are a lot of competition, or there is a lot of competition. And like you said, the barriers to entry are not that high. And so those are two things that you are continually in this race, essentially offering the same product. There are points of differentiation and speed and performance. And like you said, with Nuvei, they offer a lot of additional features that may help benefit businesses, and whether it's small to large enterprises. But the thing is, you are competing against titans. You are competing against the PayPals. You are competing against Shopify. Block is a $50 billion market cap company. So you have to compete against these companies that, to your point, Pete, maybe got ahead of the curve and took advantage of these opportunities when the time was right. And they no longer have to play catch up like maybe a Lightspeed has to. So
Yeah.
those are just things to keep in mind.
And I just think that was their challenge, to probably cost them a lot more than it costs someone coming new to market. I mean, when let's say they break into the market and they are the replacement for printing out your receipts and doing end of day reads, like, whoa, this is amazing. Like, look at your devices. This is so cool. 10 years after that, everyone's kind of going cloud and tablet based in the POS market. And I think the only thing that I might want to talk about, I wouldn't leverage 95% of their revenue being recurring as customer satisfaction. That's just the nature of the business. You get a monthly bill from them. The other 5% is likely just service-based revenue, that if you need them to implement something goes down. People in this space, when you had it to yourself, used to absolutely ding you on anything going wrong. The average person was a lot less tech savvy 20 years ago. So you'd be like, hey, your product broke. Okay, well, we're going to have to charge you $500 an hour to fix it. And people in this world, not to call anyone out, some of the companies that fall under Constellation Brands are notorious for doing this, for locking you in for very long contracts that are written really well. And then when something goes wrong, they continue to bill you for it, or if you need to make any changes or integrations. The new world of this, that again had easier times getting to the market, kind of stopped doing that. So I think that's why, if we were to probably look at this, they probably had larger percentages of service-based revenue, which is almost like an upsell, that you're paying their tech team, their support team for custom. So you are right, though. I don't know. I didn't come across of anything of exactly what their customer lifetime value is. This is an incredibly painful thing to change for a business. So it's not an easy decision. You probably want to get new businesses or give people really great deals if they're multi-store locations and maybe they're a huge retail company. Maybe you get the Gap or an Abercrombie or something like that to move over. That's kind of a big enterprise sale that, after they do that with you, they're not leaving the next year. They're going to stay with you for 3, 4, 5, even 10 years.
Well, you guys both talk a lot about competition. So inevitably, they're going to have to invest a lot in product development, user experience, things like that, just make customers happy. But at the same time, they're talking about cost cuts. So Pete, what do you think? How do they balance something like that?
Yeah, I don't know how cutting your team is going to necessarily make this product better. So maybe they were kind of just looking with that and the share repurchase program to do what a lot of corporations are set out to do, which is actually increase shareholder value. So I don't necessarily know what the long-term outlook looks like by cutting your staff, depending potentially what teams they were on. I don't think we got a lot of great insight into that. But to compete in this market, you have to have the best, most reliable product. Like I said, when I think of these guys versus someone who came in more recently, who were able to do things better, faster, cheaper without having to do major updates for their clients to remain competitive, that's likely hurting them. And they're probably having to do some rethinking of how to remain competitive while keeping costs low.
Yeah. Well, I'll push back a little bit on it, but I also do second or see your points as well. So first and foremost, I think this business, like many software companies, following the COVID pandemic and really the insurgence and influx of capital that entered the market, went on this really high growth spree where, they're hiring people at unprecedented rates. They're essentially going, well, interest rates are low, capital is cheap, and we just need to grow, and then we'll figure it out down the road. But obviously, once things started to correct and capital became more expensive, like in many businesses across Google and Meta and you name it, you can think of any software company for the most part, they started to realize, okay, maybe we probably overhired and there's a lot of redundancy throughout our business. So it is a good idea to trim the amount of employees from that standpoint. And even like Lightspeed said, I think it was their 2023 annual report that they just essentially outlined that they went from offering 9 products to just focusing on 2. And so what they're realizing is, it goes to the Pareto principle. Ultimately, they saw their market opportunities that generated the most value, both to shareholders, but also to their customers. And they focused on those. And so where those excesses they can take away, it ultimately is making a more efficient business, as Mark Zuckerberg would say. And that'll allow the business potentially to reach profitability more effectively. Now, the question is, will they reach profitability? And so you got to keep, it's this balancing act of keep growing, but do so in an effective way and don't get ahead of yourself.
Yeah, I'd tend to agree. And maybe, Kev was witness to this, the 2024 rebranding of AI, that if you had e-commerce in your name in 2020, when everything shut down, you definitely saw a very big boom. Yeah.
Huge time.
Because I actually did think they were Lightspeed POS until I was looking into them recently. And I was like, Lightspeed Commerce.
I know that threw me off too. I introduced them wrong. I mean, there's a lot to like about the stock. So it's like revenues growing. So clearly somebody likes the product enough to pay for it. The stock is way down from former highs. So it's seeing the company come in with a share buyback program. I'm actually very supportive of that. If they didn't have such a healthy balance sheet, I wouldn't be, but they have enough money to achieve their growth goals and buy back shares. Look at their total assets, total liabilities, even if you adjust them, because half, actually this, I hate seeing this, but half of their total assets is goodwill. It's like a massive line item for goodwill. But even if you completely take that out and were to ignore it completely, it's still a really healthy balance sheet. They have less than $200 million in liabilities. And however you want to slice their assets, it's well over $1 billion. So they're very healthy position. We said 740 something million in cash. So they can afford the share buyback. And this makes me wonder 2 things. Like, many things are going right with this company. The things that are going wrong is that they're losing money and they probably are running out of excuses for that to be acceptable. And margins, aren't as great as they could be. So those are kind of the 2 main red flags that pop out for me. So if the CEO, who appears to have been maybe kicked out or something, I actually don't know the backstory, but the CEO has actually rejoined the company somewhat recently. They just put a press release out saying they're focused on profitability and they're going to make a small, but some kind of move to start making it happen. And they're looking to buy back shares because they believe it's undervalued. It's, those are 3 things that are very interesting to me. After shouting from the mountaintop like a messiah, I think the CEO is probably going to take this initiative pretty seriously. I'd be curious to see if his track record would back that up, because I actually don't know anything about him. But I mean, there's a lot to like in this company. It's just they're going to have a few quarters where they really need to prove themselves. Last earnings came out and the stock tanked. That $40 million loss was not well received. I think people have just had it. So they really have to prove themselves. But maybe this is peak pessimism. It's possible.
Well, I think to your point, Kev, about the CEO. So first and foremost, I think his name is like Dax De Silva or something like that, but he's the founder of the company. And so whatever role he had kind of stepped away from in terms of like being the CEO, he's obviously returned. And when you have the founder at the helm, it usually is a good sign because their interests, ultimately Lightspeed is his baby. He's built this thing from the ground up and wants to see it successful. They also have a reasonable insider ownership position of 9.8% or so. And then ultimately, like you said about the share repurchase program, the good thing is they're buying when the stock looks cheap, especially compared to what it has been historically. So those are all positive indications, as well as strong alignment with shareholders. It's just a matter of, it goes back to the Warren Buffett saying of a manager tackling a business with bad economics. I'm going to botch the quote, but anyways, it's very difficult to be a really good manager and overcome the limitations of a bad business or tough economics. And in this sense, it's, again, there's just a lot of dilution. It's a highly saturated market. And so can they overcome those economic hurdles that have so far prevented them from reaching profitability? And will they ever get there? That's what's going to be the big question if they can turn things around.
Yeah, and we're looking forward to watching. Make sure you sign up for our premium newsletter. If you want to see our actual trades, you'd be surprised. We may speak about a stock and sound fairly similar, but when it comes to making a stance as we do in our after show reports, I think you'll be surprised. Our positions are actually very different.
I will say that we were right about 30% rip on Nuve, who that did finally look like they're going private. So that would have been in the report.
And if you guys haven't seen that Ryan Reynolds commercial, like, wow, watch it right now. He just doesn't miss.
That was a point of support for them that they had Ryan Reynolds doing their ads. So I did bring that up. That that was definitely yeah.
Yeah, watch that, guys. This has been a long episode. This is episode 17, Beyond the Edge podcast. You've got myself, Small Cap Kev, Trend Tracker, Mr. Fundamentals. We're here every Thursday. We're going to post these videos every Sunday, and we hope you're tuning in. So thank you guys for checking out, and we'll see you guys next time.